Help capture the history of our markets by contributing to the John Lothian News GoFundMe campaign to support the Markets Wiki Education history-focused video series and more.
This entry into the history of financial futures is sponsored by Eurex.
When I got in the business, I went to work for Stotler. I really expected I'd be a grain merchandiser. And there was a lot of programs in the early 70s when, we had the first explosion kind of in the same time frame as the oil embargo, that gas quintupled in price. And so did beans somewhere along the way. So soybeans that had never traded over maybe $5 in the best year hit $13.80. Just absolutely unheard of. One of the things that also did was shorten or bring the world to a smaller place and a lot more direct contact. And this is just a few years after Nixon's ventures into China, which was opening those markets, which were huge consumers. So it was all good. The idea that Stotler Grain Company also had a cash grain division. In fact, the futures company grew out of the cash grain merchandising operation, was the idea that we could trade then, cash and carry and physically take delivery when the market indicated that was, economically good to do. Yes, it was the day Reagan was elected. I think it was fairly well expected that he would win, but again, the rumor that gave way to the news became bigger than life. And so the Treasury bond contract and the Ginnie Mae contracts all open limit up. So you've got, overnight or from the low of the day before, a 3-point move on the day, it's a pretty hefty move. And I just thought it was overdone. Did one of those things you're not supposed to do maybe, but, every now and then you're right. And I sold them limit up and then did a smart thing and walked out of the room for about 10 minutes, I was there for 87, and coincidentally, the Board of Trade had opened a night session about 3 or 4 months earlier. And we had a customer business. We had customers, in the futures markets on both sides. So we had treasury bills, we had bonds, we had euros, we had all kinds of stuff. And people set both ways. No problems. Everyone, had the margins. The real problem was everyone was concerned you'd have an out trade where someone didn't verify something. And we did have one instance where within a relatively small order, within an hour, was a $250,000 problem. That was the volatility we were living with. And so it got taken care of. The customer finally admitted he had put 2 orders in on the market and was trying to say he didn't know if it was filled or not. And we tried to remind him in a nice way that if you put a market order in, you own it. Yeah. So, but it was a difficult night. The difference between, I think, the close at 2:00 Chicago time and I think we opened at 5:30 in the cash market was 6 points. So no one knew what to do with it other than the fact that this flight to quality, given the stock crash, was things that we hadn't seen that kind of volatility, a 20% move or something like that. Over the years, I was always impressed with 2 things. One was the number of people that would risk significant money of their own to come and try this, to be on the floor, to be in the market. I'm sure the life looks glorified. You trade grain, it closes at 1:30, and in the summertime you can make a 2:15 tee-off. That's really not how it works. Not that there weren't guys that did it. But there seemed to be, I worked with a few other, colleagues over the years, and maybe for 10 or 15 years, I ran one of the new member seminars, which was also a great source of humor to watch people try and figure out what their hands were saying, because now we told them they have to be like this or like that. And the rest of their brains seemed to depart. For all those that came and went through the process, obviously the number that made it was probably single digits, if that. So that was one thing. The second thing was I was always amazed at how many brilliant people over the years basically were at the Board of Trade every day. And you could get in a conversation, a Mike Forster, for instance, guys that would have, well thought out, well researched opinions, kind of belying the fact that this is all just a reactionary game. You could have a strategy to be long, you could have a strategy to spread, you could have a strategy to scalp, all of it melded together. But I found that the people that would run the brokerage firms or, big traders would always want to have a conversation because, you never knew if you got more than you gave. But you were talking to people that had one thing in common, and that is you came to the floor every day and you risked your capital. And so you have a lot of like-minded people literally in the same boat that learned, if they survived, how to manage risk. And that's why exchanges live and exchanges continue to live. So that always struck me. Now, a lot of that maybe is going to AI. So you transfer the people like myself that run the trading floor now into the engineer who's writing the code to tell the computer what to do if A happens B and, walk up or down the decision tree. But those two things, I think, really sustained and will sustain the business. I stopped, I think, in 98. So, pretty good 24-year run. Didn't get the 25-year pin, but didn't think it would be there. Yeah, they don't give much out. I think the fact is, as they say, there's old traders and bold traders, no old bold traders. But it had been a great run. I was doing other things, all related to what I had hopefully learned over the years as it relates to the internals of the market. I got involved in systems that do data aggregation for large buy-side firms that had multiple brokers and multiple contracts trying to figure out positions and then trying to figure out the economics underneath it. So I developed some stuff in that regard. I was an early user, I would guess, the way to put it. We bought computers then. It was funny. You had to have a room that you refrigerated to put the computer in, and it was the size of a small freezer. And it was eating power left and right. We actually had to leave the building. They couldn't give us enough power or cooling. This was a building across the street from the board. But we did beginning for accounting and then for some forecasting, and the more we got into it, we were early, I think, in feeding it market data, trying to understand spreads, and get some advantage. We did most of the stuff in our heads on the floor, right or wrong. And so we did a lot of that in the early 80s. Then we started to market that stuff. All the open interest is between three firms. In those days, you didn't really have any outside FCMs that were street firms, securities firms. We were in a grain company. We were in a grain business, so we were all grain houses. Each one of the firms had about 60 to 70 million of these on the books. So at very least, there's 180 million that is going to get delivered, and as it worked out, delivery day was Christmas Eve that year. So the exchange is closing early, and the story of the Ginnie Mae CDR. We had basically a warrant representing that these Ginnie Maes were in deliverable position. What happened was the customer calls, and these guys were, arbitrageurs that were trying to squeeze the last ounce. Fine, that's why they came to the Board of Trade, because there was liquidity and good contracts. What they wanted to do was figure out specific pool numbers underneath the warrant, and of course, we don't have them. And the street logic and or the street bullying, basically they came back and said, if you don't give us the pool numbers, we can't do our DVP, or delivery versus payment, of cash to those actual securities. We can't do it to the warrant. And of course, we said, you count forms, you know this going in. We've talked about this for months. And here it is, an hour and a half before the delivery. But they basically said, no pool numbers, no money, and they hung up. Merry Christmas. The scramble started. No one had gone through a delivery before. Not, Richard's firm, my firm, or Peter Totebush's, God bless him. So the three of us got together, and we were all making phone calls. Obviously, Richard in his position as the head of economics and now, managing director of Conti, got his team together, his people, and at the end of the day, Conti probably could have taken the whole delivery. That really wouldn't have helped anybody else, though, and then unraveling that, I think, would have been a mess financially. But legally, once you open this door, there's a lot of things you don't want to open. So we all decided the best thing to do is let's see if we can deliver this within the firms, as you would as if it was a botched grain delivery, which is all the back offices respectively knew. The First National Bank of Chicago, God rest their soul, was the only repository, and that's where all these certificates were. So we all walked very quickly over there and came to find out that the repository leader literally had no idea not only what they were, but maybe even where they were. We knew that we had about half of it financeable because the Ginnie Maes were still in that warrant. So if we titled the warrants back to each one of the firms, we could at least finance half of it. But you then run into the legal lending limit at Ginnie Mae's in those days was $25 million, and we're looking at a $60 million problem. So at the end of the day, we had to come up with the balance. And so you have firms like Stotler and Company at the time where I worked, Hennessy and Company where Peter Totebush was, and of course Conti. Add the other problem that it's now 11:30 in Chicago, and we've only got a half an hour to resolve this. We can't get the authorization it'll take, and now we're staring at this fail. So the short story after this long story was that each one of the firms basically took an overdraft for the difference. And that was at the direction of, fortunately, a guy named Robert Abood, who was chairman of the First National Bank at the time, who basically said, this is a Board of Trade issue, we stand behind him, and therefore we got financed. So to Richard's point earlier about the community extended. It was not only everybody, knowing what this could mean if there was a fail. It's the fact that notion of community actually extended outside the Board of Trade. No small secret that First National Bank was also a major clearing bank for a lot of CME and CBT houses. So that's the essence of the story. The fact is that Peter had to go back to Pat Hennessy, his owner, and I had to go back to Howard Stotler and the rest of the partners, who knew that we were in trouble but had no idea the specifics. I had no authority to take what amounted to be about a $30 million overdraft for the weekend. Obviously, there was a lot of problems. It just wasn't a liquid market. We didn't know if the street would support it. And when the street kind of got the idea they could use this to their advantage, it overcame their original argument against it, which is like any futures market will do, it narrowed spreads. Futures makes life more efficient, a lot more leverage, and if the liquidity went there to the Board of Trade futures contract, they knew in theory it could detract from them. The fact was they then got the idea, I think, that this could be successful. So in the, let's join, not try and beat it, we turned around and customers over the next couple of years and certainly over the next 40 that we had as customers now became competitors. They saw what the brokerage potential was. They saw the trading and the arbitrage potential. And certainly it's beyond that, lived up to it. There's also no secret to the fact that, as you know, the mortgage-backed future was just a difficult instrument. And it started with the idea that you really had two regulators wanting to control it, the SEC calling it a security, which it was, and the CFTC. At the time when we started, it was the CEA. We didn't have the CFTC yet. So grain people everywhere. I had no idea, frankly, what the security was all about, but it was loosely related to real estate or land in that context. So that's how a lot of this was negotiated. But this concept of creating a warrant or what's called a collateralized depository receipt was also new. And over the years, what's evolved is you take all the paperwork off the table and you basically come to a cash-settled contract, which is the only way I think the rest of the contracts going forward that were an index-based like S&P futures or anything that have become colossal volume leaders in the industry, avoided this kind of back office mess. The other thing that really made financial futures was the fact that we did introduce Treasury bond futures August of '77, and that was that was really the watershed event, because we first of all found the most liquid instrument on the face of the earth in a financial future, and secondly, we didn't have in the industry anywhere near the same educational curve that people had to trade a mortgage future. It was a very obviously straightforward. It's a coupon, it's interest, price yield relationships. Everybody understands that.
John Lothian News would like to thank those individuals who have contributed to our Markets Wiki Education GoFundMe campaign. Their financial assistance allows us to produce and distribute videos like this for our Open Outcry Traders History Project or the Path to Electronic Trading video series. Join them in supporting John Lothian News, capturing the history of our industry.